Crypto derivatives are the secondary contracts or financial tools that derive their value from a primary underlying asset. In this case, their primary asset would be a cryptocurrency such as Bitcoin. In our previous video, we introduced the concept of cryptocurrency exchanges and spot markets. Most exchanges, such as Phemex, also have derivative contract trading. The knowledge required to participate in this market efficiently is much more advanced. However, the sophistication of this financial instrument allows much more flexibility and control when trading. This is Martina from the Phemex team. In this video, we will show you the basic knowledge of the derivatives market. Before we start, please click the like button and subscribe to our channel. Turn on alerts and share the video with your friends. At the end of this video, we will ask a question related to today's topic. Leave your answers in the comments below along with your UID of Phemex account, and we will choose 5 lucky members to get a special trading bonus. Now, let's start. Spot markets versus derivative markets. A BTC spot market allows traders to purchase and sell bitcoins in any time, but also comes with certain limitations. For example, investors can only make money while the price of Bitcoin goes up. If the price drops, anyone holding BTC will experience a loss. Even those that were lucky enough to sell before a significant dip and intend to buy back lower, need prices to bounce back up. If those do not, then there is no way to profit. Another characteristic of spot market is that they force traders to hold the assets they want to speculate on. A Bitcoin derivative, on the other hand, allows people to trade contracts that follow the price of the Bitcoin without even having to actually own any Bitcoin. How to trade on a Bitcoin derivative market? The example is best illustrated with a physical asset. Imagine you want to speculate on the price of oil. You could actually go and physically purchase barrels of oil and sell them when prices have moved up. Of course, this is important and costly, as you would also have to consider storage and transportation fees. A much better approach would be to trade on instrument or contract whose prices is tethered to oil instead. These contracts are arguments that you sign with an opposing party. Let's return to BTC and imagine that you can believe the price will go up while another person believes the price will go down. You and this other person can sign an agreement stating that after a certain period of time, once the price have moved in any direction, one of the parties will have to pay to another the difference in price. For example, if the price of BTC is at 10,000 USD and you bet it will rise, your counterparty bets it will go down. If the price moves to 11,000 USD by the time you settle the contract, the opposing party will pay you 1,000 USD. If the price moves to 9,000, you will have to pay $1,000. As you can see, through such a deal or contract, a trader or investor is able to make money even when prices go down without even having to own their underlying asset. Though this is roughly low, derivatives work in the context of trading. The reality is that they come in many unique variations. The most popular derivatives in the cryptocurrency industry are futures, options, and perpetual contracts. What are Bitcoin futures? As described above, a Bitcoin future is simply a contract or an agreement between two parties to purchase and sell BTC at a given price at a specific future date. However, neither party is required to actually hold the underlying asset, in this case Bitcoin. Instead, they simply settle the contract in USD or any previously agreed currency. What distinguishes future contracts from the derivative instruments is the specific settlement date. How to invest in Bitcoin futures? Let's walk through an example of someone trading Bitcoin futures. One of the first things as a trader would have to decide is the duration of the contract. Exchanges offer multiple options such as weekly, bi-weekly, quarterly, etc. Suppose you want to trade weekly BTC contracts and each contract is worth 1 USD of BTC when the price is at $10,000. This means that to open a position that is worth 1 BTC, you would need 10,000 contracts. At this point, a trader can either go long or short. Whichever direction you choose when you open a position, the exchange platform essentially matches you with someone going in the opposite direction. 1 week later, when the contract must be settled, one of the traders will have to pay to another. If you choose to go short and a week later the price has moved down, you make profit. If the price has moved up, you experience a loss. What are Bitcoin options? Bitcoin options are also derivative contracts that follow the price of Bitcoin, except these do not necessarily have to be settled on their expiration dates. The reason these are called options is that they give traders the option rather to buy or sell at predetermined prices and at specific future dates. How to trade Bitcoin options? Options basic calls and pulls. If we use the same example as above for placing futures with options, the following key details would have to change. With options, you do not long or short, instead you have to call and put options. A call options give its owner the right to purchase Bitcoin in an agreed price once the contract expires. Conversely, a put option gives its owner the right to sell. With either option, it is entirely up to the owner whether they want to exercise their right or not. For example, if you purchase a call option for BTC at $10,000 that expires in a week, this means that 1 week later, regardless of where the price is at, you have the option to buy 1 BTC at $10,000. If the price of BTC has risen to 11 USD, you would certainly exercise your right, as you can purchase a BTC for a cheaper price and then sell it for 1,000 profit. If the price has dropped below 10,000 USD, you would simply choose to let the options to expire, as purchasing a BTC at strike price would translate to loss. It is important to understand that options do not offer investors a risk-free method of trading. Each option has its own price, called a premium, which varies based on market conditions. So when a trader lets their option expire without exercising their right to buy or sell, they will still lose whatever premium they paid for that option. What are Bitcoin perpetual swaps and contracts? Bitcoin perpetual contracts are derivatives that, unlike futures and options, do not have an expiration or settlement date. Traders are able to keep their positions open for as long as they want under certain conditions. One of these is that the account must contain a minimum amount of BTC. Another distinct factor to consider is funding rate. This is a unique mechanism that helps stutter the price of the perpetual contract of that Bitcoin. Because of its time limit, the price of futures contract will always converge with the price of the underlying asset at expiration. Since perpetual contracts don't expire, their prices can start deviating significantly from Bitcoin prices. A solution to this problem is to have one side of traders pay the opposing side. How do you trade perpetual contract? For example, if too many traders have long positions and price of BTC perpetual contract is rising excessively above BTC spot price, people would have no incentive to open short positions. This scenario would result in a positive funding rate. When the funding rate is positive, all long positions must pay shorts. When the funding rate is negative, shorts pay longs. This payment helps incentivize traders to close long positions and possibly open short, bringing the price back down to match Bitcoin's actual market price. To be clear, the payment is made directly between traders. Exchanges do not collect any funding payments. Once again, let's walk through an example. On Phemex, BTC USD perpetual contracts are worth 1 USD of a BTC. If the price is at 10,000 USD, you can open a position of 10,000 contracts to trade the equivalent of 1 BTC. If you are going long, you can hold your position for as long as you want until the price has increased to a level that you are satisfied with. This could be hours, days, or even months. Once you choose to close your position, the exchange will take care of paying you the difference between your entry price and the current market price. This payment is essentially coming from another trader to choose to short and lost money. The only fees you must consider are the aforementioned funding rate payments and any additional exchange fees. The scenario mentioned above is the simplest way to trade perpetual contracts. However, on Phemex, there is another element that you can incorporate into your trading. Leverage allows you to trade a position that is much higher in a value than your original margin. For example, if you use 100 times leverage, that means you can start at 100 and multiply it by 100 to trade a position worth $10,000. With the increased potential for profits comes increased risk as well. The more leverage you use, the more likely you are to lose all of your money with a small price move against you. As always, with any financial instrument, do your own research, practice before you risk real money, and never risk more than you can afford to lose. It's the end of this video. For more information and useful trading knowledge, follow Phemex Academy on our website and at our YouTube channel. And last but not least, here's your question to win a trading bonus. Do you think Phemex is the best choice for you to trade derivatives? Why? Leave your answers in the comments along with your Phemex UID and we will choose 5 lucky ones to get a special trading bonus. If you don't have Phemex account, just click on the link in the description or scan the QR code and create the Phemex account. You will get a 7-day free premium membership trial and other trading bonuses. To learn more about Phemex and cryptocurrencies, watch the videos in the box on the left. If you are new to the crypto world, have a look at the other videos on the right for some Phemex users tutorials. Thanks for watching the video. Bye!